While the index is just 3% away from its all-time high, it's the broader markets which have really been feeling the heat. Are we out of the woods? What is it that you can do to best capital protect? Who better than Ramesh Damani, our next guest joining us on the show, to really highlight what do you do in this kind of a market scenario? Ramesh, good afternoon. Such a pleasure having you on ET Now today. And who better than you, Ramesh, who's been through us past this 9-year journey. And today as well, you're here with us to celebrate our big day.
Aisha, thank you very much. A very happy 9th anniversary. And since it's such a big and important anniversary, I'm going to start by quoting English poet Lord Browning to you. He said, "Come grow old with me because the best is yet to be." So I'm sure the best is yet to be also for ET Now. And I'd like to remind your viewers that when ET Now started 9 years ago, at the bottom the index was 8,000. It closed the year very strong, almost doubled to almost 18,000. So I hope some of the good luck you had when you started for the Dalal Street we're above this year too. We could probably use a bit of good luck in the markets. But a very happy anniversary to all you guys.
To that, I hope we bring that kind of good luck every passing year, Ramesh. Though I was hoping that you will bake us a cake and send us across to our new studios.
Yeah, I know. That is still an IOU that's going on for a few years between you and me, Aisha. It will happen, trust me.
I'm waiting for that day. What's happening though, Ramesh, in the market, and I'm not talking about the index, I'm just purely talking about this broader market volatility. What's causing it and how do you capital protect?
Aisha, I mean, first let's just talk about the market itself. I think the rumors of its death are, as Mark Twain said, greatly exaggerated. I think about a week ago I checked the health of the market on a technical basis. And as you correctly pointed out, the market is just a few percentage points away from its all-time highs. There were 20 stocks or maybe 2 dozen stocks that were either at the 52-week high, their all-time highs, or within a few percentage of the all-time high. Bear markets don't begin when there's such strength in such an extraordinary group of companies as those 2 dozen stocks had last week. So clearly the market is in good shape. That in America, for example, which is the mother of all markets, unemployment is at all-time low, Dow Jones is at all-time high. So, I think people just get nervous from time to time. What is the definition of insanity? Insanity is doing the same thing again and again and expecting different results. So people who had a lot of money which were flowing into mid caps kept buying and kept bidding up the same stocks. And when they fall, they suddenly get perplexed. How can that happen? But mid cap investing is always volatile. And, if you keep buying at higher and higher prices at lofty valuations, there is some time that a break will happen and you will pay a price for it. I don't think there's anything unhealthy with the market cap or the mid cap market as some commentators are suggesting. I think it's a shakeout which is periodically happens in investing, and I think the good stocks have already started rising and they'll rise again. So personally, I'm not particularly perturbed. It has been bad, but markets can go through periods of a year where the advanced decline line is negative, but then will recover its breath and move on to make new highs, especially if it's a good quality company. I see no reason for investors not to invest today or to be very scared if they're holding good high quality businesses.
All right, Ramesh, as Aisha just pointed out, on behalf of the entire team at ET Now, I'd also like to extend out a big thanks to you for being so supportive in our 9-year journey. And just talking about the markets, taking a leaf from the answer you just gave, do you believe that while a lot of the mess in the mid caps has been sorted out, that there is perhaps reason for the market to not see so much upside as one had anticipated at the start of the year? I mean, we saw mid caps and small caps have a tremendous 2017, but we've not really seen an encore of that performance. In fact, it's only been a downward adjustment. Do you see there being a pause there and some bit of consolidation before an up move comes in?
Thank you again for your kind words. Last year, I think, if I'm not mistaken, on a calendar basis, the mid cap was up 40-45%. These kind of performances cannot be repeated. There is a very powerful concept in modern finance called regression to mean, and I think that's what we're seeing right now. I mean, if anything grows at 40%, I mean, it'll become the most valuable company in the world in the period of 20 or 30 years, and that's not going to happen. So any analyst who believes that mid caps will keep performing at the scorching rate of 40% CAGR for the next 3-5 years is fooling himself. It rarely happens except for the most extraordinary of companies like Infosys. It has CAGR'd at 35% over a quarter of a century in its listing. But it's been an extraordinary company. Most of these businesses are not that extraordinary. But having said that, let's just take a more fundamental, more nuanced view of the market. I mean, it seems to be more sound than fury in the market. That look at the three major events that took place last week in financial markets. There was imposition of tariffs by Trump. There was the North Korea summit that took place, and there was general feeling that interest rates are headed higher. After all these three in the market, the Dow and the S&P barely closed unchanged. They were actually unchanged for the week. So markets are looking more at fundamentals, more at growth, more at earnings, more at monetary policy than they're looking at these news-breaking events that are taking place. And in that case, I think we're going to do fine. For example, in terms of tariffs, for example, India is a domestic-focused economy. We don't have a lot of export compared to, say, the BRICS country. China exports 20% of its GDP. We do 9%. So tariffs are not going to hit us as badly as the other countries. In terms of, say, rates going up, the spread between the 2-year treasury and the 10-year treasury is down to almost 35 basis points. And it's unlikely that the 10-year treasury will move up because in Europe, they're still going on through a process of quantitative easing because of the problems with Italy. Japan is doing quantitative easing. So I don't think long-end rates are going to go up in the US as sharply as people predict. And in terms of denuclearization, I mean, even the Korean market is not reacting badly or positively. It's pretty stable to what has happened there. So I think given all these situations, as the OPEC meeting, that is to me the biggest risk, the oil prices. As we know more about it after June 22nd, I think market will return to a more normalized phase. I think what happened and the reason people were so suspect was the extreme volatility that took place in the, say, the BSE 250 to 500 stocks. That's just part of investing. I mean, that's the best spin I can give you. That is part of investing. I don't think there's anything more sinister behind the move than volatility is a beast in the stock market.
Yeah, it sure is, and guess we'll have to deal with more of it in the year to come. But is value emerging now, Ramesh, in mid and small caps after the recent bout of correction?
Oh, absolutely. I mean, Aisha, there is a lot of value out there. I think you can go and find high quality businesses that are significantly cheaper than they were a while back. To my analysts, I'm saying look at the luggage industry, which of course is not corrected, it remains fairly high. Look at some of the construction companies. They've had very healthy order books. They're talking about sharply accelerated earnings. They will do well. And my contrarian pick remains airlines, I think, for 2018. I think we need a break in oil prices before these stocks move up. But even if oil prices remain at $70 to $80, because they use a la carte pricing, because they price you for your seat, for your baggage, for your food separately, a lot of the pricing will be able to be passed on to the consumers, perhaps with a lag. So, I think there's a good amount of choices, technology, consumption. I mean, you want to come to India for consumers, and that sector is just booming. Look at the stocks in the consumption space, which are making new, fresh 52-week highs and all-time highs. I mean, once you look at the list, it's hard to be too pessimistic about, the market, as some commentators have been.
But Ramesh, to your point on aviation, I completely understand the point that you're making, that you're paying for everything from luggage to food to even your boarding passes. Maybe that's also a hidden cost in there. But when it comes to aviation, there are just very few limited choices you've got. You've got Interglobe sitting right on top. You've got SpiceJet somewhere in the middle, and Jet, and these are just year-to-date stock returns that I'm talking about, and Jet is still in the negative. So what is it that you do in a scenario like this? And also about the point that you're making about pricing, considering ATF constitutes for the largest cost for any aviation company, the ticket prices are as is. It's not like aviation is going out there with crude at 80 and trying to escalate ticket prices at that. So how is it that they're making money at a time when crude is bobbing upwards and upwards?
See, we need to, of course, have a break in crude. I think the June 22nd meeting, I'm hopeful that crude is at the higher end of the range and will not go higher. If clearly it goes to $100 a barrel, there will be an enormous amount of pricing pressure on these stocks. So I agree with that, but I'm hoping for one that prices will go lower rather than higher. I think a good clearing price for crude is maybe $60-65 an ounce, not $80 or even $100 as some commentators are believing right now. And some of the thing in these businesses is that you have to be patient. I mean, there's a great unmitigated boom going on in travel in India, and as we found in the US, as the number of carriers shrunk, as the number of passengers exploded, that whole industry returned to profitability after 20 years. I think we are following the same path. I mean, anecdotally at least, I don't have the numbers off the top of my head, the amount of Indians traveling domestically and internationally is going through, one of those historic booms. You can't find an empty seat on a plane. And because they're going to a la carte pricing, and they have oligopolistic market, there are only 3 or 4 major players, I think they'll be able to raise prices. For example, Bombay Airport is now operating close to capacity. So if you want a flight out of Bombay at the time slot you want it, at the day you want it, you probably will have to pay a higher price next year than you're paying this year, because there aren't that many seats available out of Bombay. So I think, given this, what investing is about, sometimes looking ahead, I'm looking ahead, I'm hoping for a break in oil prices. And if that happens, I think these companies will report fairly robust numbers. And you don't want 20 competitors having unfiltered competition in the market. It's actually a good situation. We have only 3 or 4 major players competing for the market, because then they will exercise pricing discipline.
Fair enough. Ramesh, you also like the construction space. I think an area that you're largely bullish on is the construction sector. How do you go about separating the wheat from the chaff there? Because it's a business which is primarily driven by good execution capability, and that's not very easy to assess. We've also seen over the last couple of weeks a lot of these companies run into audit issues. True or not, the fact is that it's a sector which has little regulation. So how do you go about picking the good quality names?
The regulation is there. It's fairly onerous. RERA is a fairly onerous regulation out there. You obviously avoid the debt-laden companies. I think that is the problem. The last 6-7 years, the people who have had unserviceable debt have not been able to survive. There are a few companies that are standing out after the fall of the last 6-7 years. It's been brutal. As I mentioned in the past, I'm not recommending this stock, but there was a couple of state-owned companies that are doing an absolutely bang-up job. They have a huge order backlog, and I think the execution of projects, the recognition of revenues will start from the next few quarters onward. So, I think there will be a sharp increase in profitability when that happens. Plus, the government is making all kinds of right noises in terms of mergers, acquisitions, using PSU land development banks for these companies. And I think it's priced, fairly sedately, at, maybe a high teens multiple. So, I think there will be opportunities there. Again, just for the record, I'm not recommending any stocks. I'm just explaining it for illustrative purposes.
That you also like the luggage space. Now, to my mind, there's little representation in the market. The only name that comes to my mind is VIP. Give us your rationale over here, and does it extend out your thought process for buying luggage-oriented themes is basically an extension of the consumer theme that you're big on?
It is, Aisha, it is, and there are 2-3 choices you have in there. VIP, Safari, to name a couple of them are there. But what's happening in the industry is that because of demonetization and GST, they're getting a huge wind in their favor because the industry is moving from unorganized to organized. Plus, the market itself for travel is exploding. So first-time travelers will have to buy good quality handbags to take on the airplane, backpacks, luggage to take. A lot of these companies are moving production offshore, not even to China, but to other parts of Asia where it's even cheaper. So they are seeing increasing prices and lowering costs, which seems to be the best of all possible worlds. If you look at the quarterly numbers that the airline luggage industry reported on Q4, I think you'll see signs of encouragement and signs of a long-term bullish breakout. So, it seems like a good consumption play, as you said, and also seems like an industry benefiting from, in fact, higher prices and lower costs. I just hope petrol prices remain under control, because clearly that would be a variable also for the, hardback luggage industry, which is dependent on crude a little bit.
Right. Ramesh, this is a standard question that I have to ask you. This is our 9th anniversary, so I'm going to be taking the liberty to seek your call on the markets. I mean, we have seen a fairly up-down, lackluster, maybe sideways, but in a narrow band, a fairly volatile market, not just in India but across the globe. This may not turn out to be like 2017 in terms of returns, but even so, over the course of the next 6 months, you can take a call on India, you can take a call on global markets. Which way do you think the markets are headed?
It's a great question, and obviously the answer is also stock answer, so I'm going to try and give you a separate answer. I think investors always need to assess whether we are in a bull market or we are in a bearish phase of the market. My assessment, based on what I told you earlier, the new highs, how some of the mid-cap and small-cap companies are reporting good, excellent earnings despite all this, is that we are well within the constructs of a bull market. I understand that elections around the corner, oil is at $80, interest rates are going up. These are all worries that the market will have to climb. If I felt that the market was heading to a bearish market, I would suggest taking some cash off the table and being more circumspect. But there's no evidence that I see yet that makes me suggest that we're heading towards a bear market. A bull market can last 10 years, in which 3 years give you no returns. I think most academic studies will tell you that the sharpest gains come in the fewest days of the market. In fact, in 10% of all days, maybe 90% of the gains come. So there is some truth in that old maxim that it is not timing the market that is as important as time in the market. It's very important to understand great businesses aren't built in a day. Rome was not built in a day. They can be destroyed in a couple of days, but they can't be built in a day. So you need to have that conviction that you're buying a business, you're not buying a stock price, and you want to hold that business till you see some level of maturity and upbringing in that business. I mean, it's very important for investors to understand this basic point that if you can compound your money at 18-20%, your money doubles every 3 years, and you do 10 doubles almost from any amount of money you start, you'll end up fairly rich. And I think most investors need to understand that, rather than try to focus on what's happening in the next hour, the next 15 minutes, or the next week. They try to focus, what does the business outlook look 1 year, 3 year, 5 years down the road. I think they could be better spent their time doing that than trying to figure out what's happening in the next 15 minutes, because frankly I haven't met too many people who can do that too well.
So we've talked about, Ramesh, luggage, construction, aviation, but you're the one who hunts for innovation. Where is it that you're hunting?
Well, I have been, Aisha, explaining to you, I like the cybersecurity space. The stocks hasn't done too well, to be honest with you. There are a couple of listed stocks, and they've made a little bit of appreciation depending on the price you bought it. I remain optimistic about that. I mean, my problem with the Indian technology space is that, as great as these companies like Infosys, TCS, Wipro have been for Indian investors, they are perhaps getting let off on the innovation curve. If you look at, for example, innovation in the last 10 years and look at what Alibaba and Tencent have done in e-commerce, what China has done in drone technology, what companies have done in facial technology, what companies have done in automation of transportation, electric batteries, I don't see Indian companies competing in that space. And to me, that is more worrying part about the long-term prospects of the Indian technology sector. We don't want to remain in the low margin commoditized business of services that we've actually done well and conquered the world at. But the world has moved on to a higher level of technology, and China, which was nobody in the services business, is making its presence felt in the high end of the technology game. And it's somewhat puzzling to me that we have so many Indian CEOs in Silicon Valley, but unlike the Chinese counterparts who come back to China and started businesses, India is not being able to attract the same quality of talent to come back to India and start these high-tech companies. So if you ask me, some of the worries I have about the technology space or innovation is that there's a lack of high quality innovation going on in the marketplace. India, with this fabulous market of consumers, Facebook, Google, all of them want to be in India. Why is it that we have not been able to attract people from Silicon Valley or our own domestic talent like the Chinese have done, and powered ahead in camera, drone, facial recognition, so many of these exciting technologies that are populating the world today? To me, that is somewhat of a bigger worry. We seem stuck and comfortable in that commoditized service-based business, and we've shown very little initiative to move up the higher chain. There are some companies that are in banking, security software that are doing some innovation, but it's still too few and too far in between.
All right, Ramesh. Great having you on the channel. As always, thank you so much for being a part of our programming. From Aisha and myself and the entire team at ET Now, we thank you for your support.
Happy anniversary again, guys.
Okay, great.